morning. Good morning. It's great to be back in my birth town. I have to say, how do I follow Ray? That's going to be a tough one. But thank goodness I'm 180 degrees away from peer-to-peer finance in Africa. So I'm going to be addressing the institutional challenge and opportunity in crypto. So the first thing I'd like to ask is, by show of hands, who represents a bank, a hedge fund, a family office? If you're allowed to put up your hand, please do so I can get an indication and a temperature check. Right, okay, thank you. All right, now, I think even though I would say the majority of the audience do not represent or are not willing to indicate that they work for a bank, I think this topic is really, really important to retail investors as well, because ultimately the value chain begins with every single person in this room. So, clicker. Am I going to be lucky with this? Oh, I am. Okay. So a little bit about the Redsand group. We are based in London. I have to say some of our brightest minds are not based in London. They're based right here in South Africa between Johannesburg and Cape Town. We do two things. We have worked in disruptive fintech innovation for the last 8 years. And over the last 2 years, we have dedicated the majority of our innovation efforts to looking at the blockchain as an enterprise transformation opportunity. And we have, therefore, very fortuitously, found our entry point into the institutional market, serving institutions' interest mandates to access crypto and to help them portfolio build and optimize the opportunity that crypto presents to them. So where is the institutional market right now? Well, I have to say, it probably can be categorized into this continuum, but it's as broad and as deep as the institutional market itself. So of course, on the one side, you have the deep skepticism, and on the other side, you have the absolute converts. When it comes to the institutional game, I would say we've moved, thankfully, specifically in the last 12 months, away from the skeptics to much more middle ground, where most institutions, most credible institutions, are seriously considering their entry point into crypto. So it's not a question of if they should be doing it, it's absolutely a question of when and how they do it. The biggest obstacle is knowledge, all right? And they are absolutely on the back foot, which is a huge opportunity in and of itself. So everyone is very buoyant certainly kind of in the major institutional centers of the world, that 2019 represents the move of the institution into crypto. This particular study by Greenwich Associates points to a study across 140 hedge funds, family office, banks, as a temperature check, and 70% of these organizations said that they're absolutely committed to considering crypto as an important constitute of how they portfolio build moving forward. And today, and I would say we are testimony to that, we are seeing quite a variation in the average transaction flow from an institution, anything from 100,000 or so upwards in a single transaction, that is dollars, I have to qualify, right up to 30 billion. Moreover, generally speaking, transaction flows of about $250,000 and above are typically in the hedge fund territory. So, who are some of the early movers in the space? Well, there's quite a lot of activity going on, and it's actually quite diverse. But it is very, very interesting to see how the forerunners from this community are taking a stance or a position. So, I think we've heard enough about JPM Coin. I just wanted to say this is still a proof of concept. It's not going to be a reality, certainly not from a retail perspective for at least another 2 years. So that said, let's look at some of the other players. Citibank have actually taken an interesting stance to providing investors exposure to crypto. Citi have a derivative product called the American Repository Receipt. That's a mouthful. And they've actually a financial instrument that they've developed themselves, and they've taken a digital asset receipt to take on that to help support access for their own investors. That's one example. If you look at the announcement by Goldman Sachs last August, we're still waiting, folded arms, I have to say, for their move to provide custodial services to cryptocurrency funds specifically. So, you know, there's been a lot going on with Goldman Sachs in the futures markets, but this is an interesting one. And then on the custody theme, Fidelity have made a very, very bold move to actually provide custodial services for their peers in the institutional market, which is one of the biggest challenges facing any institutional player is essentially custody of these digital assets. What I find particularly interesting is the move by Morgan Creek. So Morgan Creek is an alternative investment fund based out of New York. For those of you who are avid pump followers on Twitter, you'll know that Anthony himself is a partner in their digital asset fund, and they have just succeeded mid-February to raise $40 million into their fund from 3 pension or retirement funds. Now, I find that particularly interesting because certainly the pension funds and the LPs, you know, we'd probably say are the most conservative of investors in the institutional landscape. Well, what I'm starting to see is the bypass mechanisms that these typically quite conservative investors are taking in order to get exposure to crypto. And this is not the first time. There's certainly been a move by the Ivy League community, so Harvard, MIT, Stanford, of gaining, I think it was through endowment structures, I mean, probably a year back. So that's a really interesting move from this particular community. Okay, so why and what does exposure to crypto mean for an institutional investor? Well, the first thing we spend most of our time doing is educating them that crypto is no longer and cannot be considered a financial instrument of the past. So that has massive implications. They don't have the people, they don't have the processes, they don't have the historic legacy knowledge to apply in order to capture this market with speed. So they're having to rely on networks, they're having to rely on resources that generally speak a completely different language. And what they're struggling to get their heads around is, first of all, the decentralized nature of a crypto asset, all right, the deep technical know-how that they as an institution have to have. Many of you in the room would be absolute peak targets for them to capture in terms of your technical know-how. But this is very, very important because the roadmaps, the health of that particular token structure are vital to determine economic models such as issuance. If they get that wrong, all right, and they don't understand, okay, the supply of a particular token from a particular blockchain, that could have huge consequences for when inflationary pressures become relevant. So the deflationary and inflationary pressures from just the simple issuance model are something they really have to get their heads around, and that's a skill that they all kind of grappling with. The other very obvious factor is valuation models. So I'm a big fan of Chris Beninsky, and certainly, you know, as a leader in terms of valuing, as a lead voice in the valuation of a cryptocurrency, I think there's a lot said for the model he's introduced, which is really an extension of the kind of monetary supply formula. However, not all crypto assets are cryptocurrencies, right? So the lack of standardization in valuation models are a big consideration as well. Right. Other considerations, well, as I've just said, crypto is not just cryptocurrency. Crypto commodities are very valid, all right? Crypto is being used for data storage, for power, valid, incredibly important to this new world order. The notion of crypto tokens, which are exchange mechanisms for other blockchain assets as well, are a different classification. And then, of course, volatility and speculation. Now, there is a theory that as a crypto becomes more pervasive, and it certainly demonstrates utility, it becomes less speculative because people understand it, right? And that therefore means, all right, there's potentially less volatility. It's, pros and cons. But this mechanism is really, really important when you are responsible for building a multi-billion or multi-million fund structure. So, much of what I've said could be construed as both opportunity and challenge, but I'm just going to specifically delineate the really specific challenges facing this industry right now. So first and foremost, because we live it daily, is liquidity. Guys, I've got my team here in the second row. They know what I'm talking about. So whether you are sourcing access to liquidity on or off exchange, this remains the biggest factor. And for sure, there are all kinds of implications in liquidity restrictions, both in terms of the price you pay, the volume of trades you can do, the size of the trades you can do, etc. When you look specifically off exchange and you look at the OTC space, well, then I don't even know if there are rules, okay, I have to say. But let's say the rules of the game completely change, right? And in a bear market, again, we've had so much experience with this, right? The seller networks rule. And, it is literally like two galactic entities. There is completely no correlation in understanding these two parties on the buy side and the sell side. And that creates enormous frustration for the traditional financiers in this space who are used to much more clear, more transparent ways, if I can put it that way, of accessing pools of liquidity in other asset classes. Right, so the next thing is custody and custodial services. I mean, it is a really foreign concept for an institution to have to get their heads around cold storage via wallets, right? So that's why the move of the likes of a Fidelity moving into the space and serving their institutional peers, I think is a very, very good thing. And then, of course, regulation. We've got quite a lot of today's agenda dedicated to the challenge of regulation. And I've got a heat map that I'd like to talk to just after this particular slide. But the one thing I'd have to say is, on the, kind of being polite, okay, the regulatory framework is diverse. Being not so polite, it's totally schizophrenic, right? So, however, a point to make is the world still looks at the SEC for guidance, and the SEC considers certainly BTC as a crypto, not as a security mechanism. And this, of course, precludes most of the institutions that have to be regulated and only deal in security structures and assets. So that means they're all finding, well, they're not all, they're either sitting back or finding other mechanisms to enter the market through brokers and intermediaries, which add cost and complexity to the system. I was party last February, actually this time, to position the case for crypto in Prague to 50 central banks, which was pretty much just me, all right, and a sea of either completely disinterested, suited and booted individuals, and one or two quite progressive central banks who were actually looking at the issuance of digital currency, but sovereign digital currency for themselves. Very much a lone voice. The FSB, who represents regulators, and central banks globally, has just issued a paper, and I can already see the tone changing. So central banks are starting to change their position on crypto, and I think that's amazing. And the forward-looking central banks, and I believe we have participation of the South African Reserve Bank here today, yay. That is really, really healthy, right? Working with the community, understanding how to really consider the systemic impact, not now, but certainly in the future, of crypto assets is key. And then the FSB is also taking a particular progressive move, I think, through the G20 finance ministers for actually working with kind of key countries within the G20 to get some kind of consistency in how they approach and tackle regulation. So I don't suppose that this is incredibly clear for those at the back of the room, but on the left-hand side, the yellow key is really where crypto is legalized. By the way, health warning, this is a snapshot taken in January, so it could have changed by now, as these things do, to the light blue, which is a complete ban on cryptocurrency. So you can see that even within macro regions, there is, let's say, diversity on the one side, but, quite a lot of confusion. So Europe, obviously being based in Europe, what we're seeing is a lot of institutions that are either multi-jurisdictional, have either European or global coverage, are actually taking this as an advantage, right? So regulatory arbitrage, they're finding means and mechanisms of actually setting up entities and jurisdictions where they can actually support the demand for exposure to crypto from their investors. And I just think this is an economic development opportunity or a real kind of issue that certain jurisdictions are missing out on. What we are seeing is some of the more progressive jurisdictions are the smaller ones, right? So we'll hear from Bahamas. We have, I think we have some participation from the Maltese regulator here today. So these jurisdictions are actually coming to the fore. Switzerland, I consider an island, of course. So yeah, they are one of the leaders in the pack. So what is the opportunity? So, well, first of all, the kind of headline is, this is, definitely not going away. So even if you get in now, you're still absolutely long in the cycle, right? And as a team, we like to joke, but I think hopefully there is some good facts behind these numbers. But essentially, there was the feeling or the kind of sentiment that if you wanted to enter into crypto, then essentially you put an allocation in that you could afford to lose. That has changed, all right? We believe that at least 6% of any portfolio, any traditional portfolio, should have exposure to crypto if you're bullish. If you're bearish, maybe 1%, and if you're in between, 2%. That's just our position. I'm not going to debate. I'll call on Toby to actually back me up in making that absolutely valid. But the important thing is crypto provides risk mitigation to traditional asset classes because of the correlation differences, right? So it's a big opportunity. Crypto can also be used as a hedging mechanism, all right? Just like gold, just like oil. So those are important considerations to think about. Then retail investment is still absolutely in high demand, even in a bearish market. Not so much from the kind of low value or low entry levels, but from certainly the high net worth and upwards, because they understand the importance of actually getting in on the bottom of a particular asset class. And so that's forcing wealth managers and private banks to actually consider, what do they do? How do they serve these customers? And then for the strategic investors, and I wish all investors were strategic, but they're just not. Okay, but for the strategic investors, crypto is both a speculative opportunity, but it is an infrastructure opportunity. Why wouldn't you want to get in on what is building the new business models, right? The new infrastructure of the future in terms of blockchain. Okay, so how do you get into the space if you're an institution? Well, that's an exercise in and of itself. On the left-hand side, we've just kind of outlined a few key considerations. And on the right-hand side, I'll just take you through some of the examples out there and why, some of the exchanges and some of the brokers and desks vary so much. But essentially, you should definitely consider the portfolio options to you, right? Do you simply want to transact? What are those volumes likely to be? What is the frequency like to be? Will your service provider, whether it's an exchange or some other desk, be able to service that continually? What is the approach to OTC? OTC is an esoteric, very bespoke service, and it can be very, very costly, both in terms of times, resource, legal efforts, etc. The onboarding process. I don't think there's an exchange that serves an institutional market that we've seen that operates in, they're all completely different, right? Which is an arduous process to get on boarded, but, it's something to consider. The time to trade, okay, what we typically term the trade life cycle. I think I've pointed to that before. Any limitations, right? So we've talked about some of the liquidity limitations, but as a regulated entity, you may be looking for an exchange that could be or that is regulated, and therefore there are jurisdictions that you'd have to consider, because only certain jurisdictions are actually willing to license and issue licenses for exchanges, and then of course the pricing model. So if we look at some of the kind of major retail exchanges that are moving into the institutional space, Coinbase is due to launch their OTC institutional desk quite soon. But again, there you're limited to, I think, 8 pairs, 8 cryptos. Binance have come into the market, and there you've got access to over 80. Right, so that's a consideration. Coinbase are very transparent on their entry point in terms of the minimum threshold. I think it's $250,000. Binance, you can't really get that information. It's very much a case-by-case basis. Then you've got Genesis. Genesis is the blue, bright blue logo. They're New York-based, highly bespoke, very expensive, 24/7 trading desk. They'll handhold you in some cases. If you're big enough and you're wild enough, you'll actually get your own dedicated trader. Gemini completely different. So the Winklevoss guys, right, behind Gemini, there the entry point is 75 BTC, so they don't take a dollar threshold, they take a BTC threshold. And then why I've got LBX and Circle is actually they've come to the fore with settlement solutions, right? So instant settlement solutions. So Redsand Exchange, we work very closely with LBX because they onboard a lot of our buyers, because they're actually the only European multi-service exchange that has issued their own stablecoin, and it's a pegged GBP or pound stablecoin. Because we operate both a desk, an OTC service, and a portfolio management and optimization service, we have had to normalize and standardize. And how we've done that, one of the ways we've done that is actually we onboard our institutional clients using stablecoin. All right, some of the majors. Okay, so this is my last slide. Hopefully I'm good for time. Wow, okay, wow, all right, Fazam, thank you. So what's ahead, right? What does the future look like for institutional investors in crypto? Well, a lot could be said. I've only pulled out 2 things. First of all, we are all heavily awaiting what will happen with the BTC ETF. There are 2 additional lodges now sitting with the SEC, so probably around about April we'll hear why this is important. This will really facilitate those institutions that have been restricted because they can only deal in regulated securities enter the crypto market, because essentially as an ETF they don't have to, investors don't own the underlying asset. Now that's really important because there is a greater retail audience who would take advantage of that. So that'll be an interesting move. The other thing is essentially the whole area of wrapped BTC or any of the kind of wrapped coins. So this is a stable coin mechanism, smart contract effected, that is Ethereum based, which allows interoperability. Why it's so interesting in terms of Bitcoin is, first of all, it allows essentially Bitcoin to be effectively, the Bitcoin liquidity to move onto the Ethereum network. So not only is that very positive from a trading perspective, but that actually allows Bitcoin holders to gain access to assets on the Ethereum network and the vast array of ERC20 applications and DApps. So it's a really exciting move. I know for the techies in the room, I'll get maybe some brownie points for saying that, but actually, really don't go too deep on questions on me on that particular topic. I'm going to have to default to my technical team if I get those questions. All right. And that's us and me. So, please reach out. We'd love to hear from you. And it's a delight to be here. And I'll be sticking around for most of the day. Thank you.
Thank you so much, NICOLE.